It's going to deteriorate. Inflation is here to persist. Commodities are set to surge. Oil prices will skyrocket. Bonds are poised for a crash, and gold has been in a rather peculiar situation, which is as follows. Typically, one might ask, if inflation is looming, why isn't the price of gold soaring? And why on earth would gold prices rise if there's deflation or disinflation? The response to this lies in examining the yield to maturity on the 10-year treasury note, our benchmark security. Many people may consider LIBOR, but from my perspective, if you're making long-term investment decisions, such as buying a house or undertaking capital investments, the 10-year note is the appropriate benchmark. This is because these are substantial, often decades-long commitments. Well, this note serves as an alternative destination for capital. You can either invest in gold or purchase a 10-year treasury note. So, what has been the case since last summer is that as the yield to maturity on the 10-year note increases, it strengthens the dollar, leading to a decline in gold prices because the dollar price of gold is essentially another exchange rate. A stronger dollar means a lower dollar price for gold. However, if the yield to maturity on the 10-year note declines, it weakens the dollar, causing the dollar price of gold to rise, as a weaker dollar implies a higher dollar price for gold. Curiously, the price of gold is not being primarily driven by abstract inflation, but rather by the strength of the dollar, which is inversely related to the interest rate on the 10-year treasury note. But here's what has changed. I often discuss gold bull markets and gold bear markets, and my analysis begins in 1971. You might wonder, Jim, why 1971? Why not earlier? Well, in 1971, Nixon ceased the redemption of dollars for gold. Prior to that, Americans couldn't even own gold, and it was a controversial matter. However, foreign trading partners could exchange dollars for gold until 1971, when Nixon put an end to it. Before that, gold was essentially money. Under the Bretton Woods system, gold was fixed at $35 an ounce. Before Bretton Woods, it was pegged at $20.67 an ounce. Going back to the 1920s, and even earlier, during most of the 19th century in the United States, gold was considered money. For the British, the sovereign, which was approximately 8 grams, a bit less than an ounce, was their currency, worth 4 pounds and change. Even as late as 1913, if a Briton traveled from London to Bombay, now Mumbai, they carried British sovereigns, which could be spent anywhere worldwide. So gold was actually money. It wasn't a question of exchange rates. Gold was the money, and its value was determined by its weight. However, since 1971, when we fully detached from a fixed exchange rate, we have had to consider the dollar price of gold. It's no longer a fixed value. But why did we lose this perspective? What happened to the 30-year history I just mentioned? Well, this shift happened gradually over about 75 years. It began in 1914 with the outbreak of World War I. Countries needed gold for the war effort. In response, citizens were asked to deposit their gold in banks, receiving paper money in return. However, the gold was then melted down into 400-ounce bars, which made it impractical for everyday transactions. It remained in the banks, but was no longer directly accessible. Step 2 occurred during the 1930s when central banks took the gold from commercial banks. The Federal Reserve System instructed banks to send their gold to regional Federal Reserve banks. Most of the gold ended up in the Federal Reserve Bank in New York, so the gold was no longer in the commercial banks. But people still believed their paper money was backed by gold, even though they hadn't seen gold in circulation for a while. Step 3 took place when the U.S. Treasury and Finance Ministries took the gold from central banks. The U.S. Treasury confiscated the gold held by the Federal Reserve System, giving them a gold certificate. If you explore the Federal Reserve System's balance sheet today, you will find a line item for a gold certificate valued at $11 billion. Using the gold's price of $42 per ounce. However, at today's market value, it's closer to $470 billion. So, the Fed has a hidden asset of over $450 billion that is not accounted for on its balance sheet due to a gold certificate. But it's important to note that this certificate does not represent the physical gold. The Treasury holds the gold. The gold is stored at 2 Army bases, West Point and Fort Knox. In essence, the gold is safeguarded by the U.S. Army. Despite this, the general population no longer discusses gold's role as money. It was gradually hidden, taken away, buried, and stopped being taught. The teaching of gold's monetary role was phased out of academic curricula, and now 2 generations of scholars have little knowledge about gold. Meanwhile, Russia is an example of a country that still regards gold seriously. In contrast, in the U.S., we maintain our gold reserves of 133 tons. We haven't sold any gold since 1980,